section that he has. Anyways, I'm going to be discussing within this topic if distributed ledger technology will be capable of disrupting jurisprudence in the same way that Bitcoin has disrupted the banks and financial services market. Now, to do that, we need to sort of distinguish between different technologies. So, distributed ledger technology is a holistic term, and it encompasses a different range of new technologies, including blockchain, which Bitcoin is an example of blockchain, and we'll look into how a blockchain is made. And what is the meaning of distributed ledger, how this differs from a cryptocurrency, and what a cryptocurrency is. And essentially, we will be looking at digital transactions and the current state of the landscape of digital transactions, and how this potentially will affect future jurisprudence as well. So when we think about distributed ledger technology, it is better to think about it as a sort of a holistic kind of technology, which is based on a number of different technologies. So if you think of a distributed ledger technology as being comprised of three essential components, in the same way an atom is made up of three essential components. The components of the atom are the nucleus, which contains the proton and the neutron, which are two parts of one atom, and the third part being the electron. Now, different combinations of protons, neutrons, and electrons deliver all sorts of different atoms that are capable of that have completely different characteristics. Now, in the same way, distributed ledger technology can be built up of different combinations of their subcomponents to deliver completely individual technologies and applications and solutions to problems that we have. In the simplest terms, because we could talk about this I could do weeks on this subject, but essentially distributed ledger technologies, in particular blockchains, have three subcomponents in the same way as an atom has three subcomponents, and these can differ in their capacity, but they generally do the same thing. So the three different components of a blockchain is, number one, how that blockchain is secured; number two, the type of infrastructure of that blockchain; and number three, the data that is inputted into the blockchain. So let's break that down a little bit further. What is a blockchain, number one, right? and how do you make a blockchain? Well, a blockchain is essentially a block of data. That data can be anything from the details of a transaction to a digital file, a picture, a message, anything, right? That is a block of data, and it is placed into a cryptographically and mathematically verified block that is linked to the last block of data and the future block of data. So that is it is encrypted in a number of different ways, and that is the way that it is secured. Now, the type of infrastructure in how that database, those blocks of data in a chain are kept, there are different types of infrastructure, network infrastructure, to maintain that block of data and that chain of data. And third and lastly, that we touched on a little bit previously, the type of data that is put into that blockchain can differ variously. It can literally be anything digital that you can imagine can go into that block of data to be secured on a blockchain. And that, my friends, is in essence what a blockchain is. It is a chain of blocks of data that are time-stamped and mathematically verified and secure. So now we kind of understand what a blockchain is and the kind of what are the number one example, like what is the main use case of distributed ledger technology? Let's look at the first blockchain that was ever created, which was Bitcoin. Now, Bitcoin was a proof of concept. A number of the sub-technologies that were incorporated into Bitcoin were also incorporated into previous projects, but they never really took off. An example of this is DigiCash, Hashcash, the work of David Shom, and so forth. But essentially, it incorporated a number of sort of bleeding edge cryptographic and mathematical technologies, a number of them being like Merkle trees, Shor signatures, elliptic curve, and so forth. But we can't really go into that. I mean, you need to do a computer degree to kind of understand that stuff. But essentially, if we think of cryptography as dating back, as a discipline dating back to the Enigma machine and the cracking of the Enigma code in World War II, to today, where we are developing algorithms that encrypt data that make it impossible for anyone but the sender of that data and the receiver of that data to be able to read the data. That is essentially what was one of the main proponents of Bitcoin in securing it. So it number one, it was a proof of concept. Someone bundled all of these sorts of bleeding edge technologies together, probably 100 years or 200 years before they should have, and they created this network, which they claim to be, in theory, the most secure, immutable, censorship-resistant network that has ever been built in human history. It is permissionless, trustless, and transparent and easily verifiable. So you can verify any data on the network, and it's open source, borderless, and globally accessible. So in this instance, if you are going to create the most secure network ever created in data science and cryptographic science, why don't you put your money where your mouth is? Now, the most simplest form of data that you can put into a block is transaction details, the movement of currency. So they ran currency as their first application on the Bitcoin network. The Bitcoin network has now been successfully running for over 10 years. It has had the entire network value of all of the digital assets on that network is in excess of $1 trillion. It is the sixth biggest currency, if you want to call it that, in terms of market capitalization in the world, and it's only 10 years old. And it's the most secure, immutable, censorship-resistant data network that has ever been created. To put that into perspective, if we look at our other currency networks and our other financial services networks that are currently being used around the world, you've got the likes of the SWIFT network, the Fed exchange, even the Visa and MasterCard payment networks. These have a number of different security vulnerabilities that lead to the loss of around $500 billion every year. Now, to put into perspective how much money $500 billion is, that is enough to end world poverty 3 times over. And that is lost to security vulnerabilities and misappropriation, where money has been wrongly misappropriated or even rightly misappropriated, and sort of the inability to trace lost funds through these networks that can be easily exploited by people that understand how to exploit them. On the contrast, and companies like SWIFT, Visa, MasterCard, they spend tens, maybe even hundreds of millions of dollars to secure their payment networks. And on the other hand, Bitcoin has been running for 10 years and not a single penny has been spent on securing the network because it does it naturally. It's the most secure network in the world. It is secured by computational power which is used to encrypt the data on the network. As we talked in the last slide about security, the computational power that is required to maintain the Bitcoin network is in excess of 3,000 of the world's most powerful supercomputer. So in computational terms, it's in hashes. So hashing is the term that is given to the capability of a computer or a person, because you can actually hash mathematically by hand. If you're a human calculator, you can hash and encrypt data yourself. It's not easy. It's very, very difficult, and a computer can do it a million times better. But essentially, it's not impossible either. But it's So the entire computational capacity of Bitcoin makes it the most powerful computational network on the planet. Which, to put that into kind of a term that we can understand, I think the most powerful supercomputer is being, it's a competition between one in the US, and I think there might be one in Taiwan, but essentially it would be at least 3,000 of those, and you still wouldn't have the computational power of the Bitcoin network. And just to bear in mind, there's only one of those supercomputers in the world, and not 3,000, but the entire Bitcoin network is 3,000. And all of this data, all of these blocks of data, they are accessible globally by everybody around the world. And every participant or node on the Bitcoin network has an exact copy of the entire Bitcoin blockchain, and every single transaction that was ever done on the Bitcoin blockchain exists on every single node. And it requires a lot of computing power to hash all of those transactions and to store them on every single node that exists on the network. So to do this, you require a lot of computing power, but this also means that the entire network is completely transparent and open and easily verifiable. You can go and see every single transaction that has ever happened on the Bitcoin network since its inception. And that means that you can basically track and trace the movement of every single Bitcoin on the network. So an example of that is here. We've got the movement of a number of different Bitcoins. I think in total there's got to be a couple of thousand, but you can essentially see every time that Bitcoin has moved from from a service to another service. So you've got a cash point at Old Street Underground Station where someone probably deposited that Bitcoin to receive cash. You've got Coinbase, BitBay, Binance, which are all sort of operators of their own Bitcoin wallets. But you can see the movement of Bitcoin to and from these different accounts, and you can see them in real time, or you can go on the Block Explorer. It's called the Block Explorer, and you can see historical transactions that have happened from the Genesis block in 2000, and I think it was 2009 or 2010. But yeah, so the idea that Bitcoin makes people anonymous is completely false. You are more anonymized if you use traditional digital currency in your mobile banking app. Because when your bank sends money to another bank, when say NatWest sends money to HSBC, they don't send it direct, like it is done by a payment messaging system usually. So that kind of bundles all of the transactions for the day in what's called the clearing period, and that is bundled together. So your money is bundled together with everybody else that send money to a HSBC bank account, and that is settled at the end of the day usually. Though it's a little bit different now because we've got some new regulations like PSD2 and so forth that is supposed it's supposed to make it more less anonymous to kind of see the people that send payments. So essentially, what Bitcoin does is it prescribes a digital or a blockchain does it prescribes a digital identity to every single transaction that happens. Now, when we think of digital transactions, we're quietly unaware of the amount of scope that digital transactions dictate our uses, our lives. Essentially, we are committing to and performing hundreds, if not tens of thousands of digital transactions on a daily basis. When you click on a link, send a message, even walk around with your mobile phone, you are basically transacting with a number of digital databases, and this involves essentially you giving an invitation to treat, a request, a data request to a central service, and they can either accept or refuse your invitation to treat and provide you that service. Think about whenever you click like on a Facebook post, or when you open a link that a friend has sent to you, or when you respond to an email. All of these are forms of digital transactions that currently happen, up to in the tens of thousands of times a day. When you walk, your phone is digitally transacting and sending your location data to either Google or Apple, and these can essentially accumulate as well when you are web browsing on cookies. So these are a number of digital transactions that are manipulated and used to create even a digital identity of you, in the sense that these people can use these the access to this data to create a digital identity of you. If for example, if I had access to all of your location data from your phone, it's been done within a recent study that I can accurately predict with over 90% accuracy where you are going to be at any given point in time, with 3 guesses, which is crazy. So knowing the location of any person based on their location data is pretty easy for companies like Google and Apple. This is, in some respects, a vulnerability. We don't have any control over who has access to this data and how it can be viewed and how it can be stored. And blockchain and distributed ledger technology can provide a solution for that. And essentially, this can lead to a whole host of problems, like where there is data breaches with the likes of Facebook, Google, and these other companies. Your data can be compromised, and the amount of data they have on you is huge, and is very, very underrepresented. Facebook collects location data as well as Google, just by having the app installed on your phone, and a lot of applications have access to that data as well, and they store them in data silos, and what they do is they sell them. And sometimes they don't even need to sell them, because nefarious actors will gain access to these databases and exploit the vulnerabilities, the security vulnerabilities that we talked about being on the financial networks, are even bigger in a lot of cases on these private company networks. So your data isn't that secure. It's less secure than your currency on these third-party applications and these private companies. And essentially what this means is that they can gain sort of, an idea of your digital identity, like what websites you like to go on, what things you like to read, who your friends are, where you're most likely to be, who you're most likely to see, and so on and so forth. And it can be very dangerous. It can be used to either extort funds from your bank account, or blackmail you, or a number of different uses, or even steal your own identity and go online and pretend to be you. And essentially that's what happens. So, as I just described, a lot of this is used mainly for personal data and payment details, but it extends to other things such as state secrets, trade secrets, know-how, and so forth. And I think one of the biggest examples of sort of state secrets is was the Hillary Clinton Act, the Hillary Clinton email hack in 2016. And where hackers gained access to Hillary Clinton's emails and published them all on WikiLeaks. So these data vulnerabilities are a real problem. And blockchain and distributed ledger technology, where the umbrella of different distributed ledger technologies aims to try and fix that. So let's kind of unpick what a distributed ledger technology. We've looked at blockchain, we've described blockchain and how that works, but what about distributed ledger technology? Why is blockchain a distributed ledger technology? Number one, blockchains are distributed in the sense that they are stored on a number of participants' computers. So an identical copy of each of the entire Bitcoin blockchain is stored on every single Bitcoin node on the network. So that means if I wanted to corrupt or change or ruin one of the transactions on the network that had previously happened, I would have to change all of the nodes, all of the participants' copies of the ledger on the network, which is logistically impossible with Bitcoin. I mean, you'd have to have access to every single person's computer to manually to be able to change. And it's even harder than that because you have to decrypt it as well, and the computational power to decrypt and change all of the participants' ledgers on the computer is just astronomical. It's even more than the 3,000 computers that are used to secure the network. To break the code, you need more than 10 times that number of computational power to be able to break it. Which means, currently it's logistically impossible. Why is it a ledger? As we described, it can be any form of digital data, and it is a ledger in the sense that all of this data is time-stamped and cryptographically encrypted and placed on the network. It's all kind of one way, so you can't reverse a transaction. Once that transaction has happened, it is recorded for eternity on the blockchain. And this means that Bitcoin is immutable and censorship resistant, in the sense that I can't delete a transaction once it's happened. Once that transaction has happened, it is stored on the blockchain forever. And essentially, what that means as well is that once the transaction is on there, essentially once the transaction is on there, it is immutable, in the sense that the network is essentially like, if you think about it as well, it's the most immutable data record of truth that has ever existed in human history. There is no network or record of truth that has ever been so secure and so sort of autonomous and democratic as the Bitcoin blockchain. And it's been running for 10 years, and every single transaction that has ever happened is stored on there for the whole world to see. Why is it technology? Well, like I said, it's an umbrella. Like DLT and blockchain, can encompass a variety of different technologies and different protocols and different rules. And we'll look at the definition of protocols. So here we have the example of the internet, which, the first internet application was email, right? And the first email was sent by a guy called Ray Tomlinson back in 1970 between two computers. And this was the starting block for the internet as we know it today. You guys might be watching this on a Google browser, and it owes its existence to this instance that happened in 1970. Now, from 1970 to 1990, all of the internet applications were email-based text applications. So in the beginning, it was used for peer review. So people used to send journals by peer review via email to other people, even though it was a very rudimentary process and very, very sort of only like in the realm of like data scientists and computer scientists who were very small back then. But yeah, it was genuinely used at MIT and other universities. And essentially it took until 1990 for the internet to get its next biggest application, which was the World Wide Web, created by Tim Berners-Lee, which we still use a number of the protocols that he developed to this day. He developed the three main protocols, which were HTML, which is kind of for content service, though we are way, way ahead of HTML now. We use a lot of other different content type code on the internet, from like Java to so forth, but HTML is still used on some websites. URIs, which are now URLs, so these are the addresses to certain services on the internet, and the HTTP, which is now HTTPS, which allows us to transfer the data from one resource to another. And essentially, these are the backbones for the internet, in the same way that we've got different, and these have developed and changed over time, in the same way that we're seeing distributed ledger backbone technologies being changed and updated over time. But the proof of concept was the first application, which was the email, and we are still sort of we've just passed the proof of concept stage, and the applications are currently being developed, and the new protocols are being developed. So how has this disrupted finance, and why has distributed ledger and blockchain disrupted finance and financial markets? Well, first and foremost, we've discussed how it can, currency is the simplest and easiest form of application to run on this technology, and essentially that's really affected international remittance. Primarily, international remittance is the sending of money all around the world. And for example, if I was to try and send £1 billion from the UK to Canada, I would need to open a UK bank account, put that £1 billion into the UK bank account, which would be subject to capital gains tax or whatever tax it is. It could be any type of tax. And then once that money is, once I've opened the bank account and deposited the money in the UK bank account, I'd have to open a bank account in Canada. To open a bank account in Canada, I would need to get passport, citizenship, and all sorts, and it can take years on end to kind of finalize. And then once I've got both bank accounts set up, and I can use my IBAN number to do international bank transfer via the SWIFT network, that would take God knows how long, and each bank would also charge me a bunch of money to process that transaction, which can be as high as 5%. Now, 5% of £1 billion is 50 million. So I would lose £50 million just to transfer that money across borders. Now, if I wanted to transfer the same amount of money via the Bitcoin network, I just have to open up two wallets, and which is done instantly. And then once I open up the wallets, there is kind of no barrier to me sending $1 billion from one wallet to the other and accessing that wallet from either the UK or Canada. and that transaction would cost. It could even be free if I wanted it. But if I wanted the money to be processed within sort of 10 minutes, I could pay, say, 10 to 50 pounds to the network, to the miners on the Bitcoin network. And that transaction would be processed within an hour. And that's essentially the very, very disruptive to finance, especially a lot of companies that depend on international remittance, like that depend on international remittance for their income, like Western Union and those sorts of companies. And essentially, there is no barrier to entry. Anybody around the world can open a Bitcoin wallet, and they can use it from anywhere in the world. And they don't necessarily even need access to the internet. You just need your personal and private key, which again is part of the Shore signature process and how those are created. But essentially you've got a public key and a private key. The public key is visible to the entire network. The private key is only visible to yourself. And essentially what this allows you to do is the private key is needed to authorize the sending of funds, and the public key is just needed to know where to send those funds. And that's essentially it. And those keys, the public and the private key, allow every person around the world to have access to their own digital Fort Knox that they can store in their heads, because you've got the most secure form of data security at your fingertips. And if you can store your private key in your head, nobody around the world can access your money on the Bitcoin blockchain apart from you, which is, extremely huge when you think of the amount of credit controls and, orders that the court can use to access people's money and people's funds. Those simply are not available on the Bitcoin blockchain. If that person hides his private key or he dies with his private key, the Bitcoin in his wallet dies with him as well. So so it's been extremely disruptive. But then on top of that, we're talking about a digital currency in the sense that it can be programmed with secondary and tertiary applications on top of it. In the same way that you have secondary and tertiary applications on your web based applications, like when you log on to Blackboard, you are using an application that is built on the HTTPS and the URLs that we were discussing earlier, like that allows you to send and stream video wirelessly in some cases. So there are other applications that you can build on top of distributed ledger technology and blockchains a lot easier, that are capable of doing what the traditional applications have been doing for a lot less money and a lot less resource. And this is where we come into financial instruments. You can program a cryptocurrency to do all of these sort of applications. You can program a cryptocurrency to do the functions of an equity instrument, or a loan or a bond, which we've got now with DeFi. If you go and Google what DeFi is decentralized finance, which gives you the option to do financial options, swaps, and ICOs. You had initial coin offerings, which were basically to try and were a derivative to try and get credit from people. So all of these old school applications that had their own kind of regulatory framework. So the regulatory framework for equity is different from the regulatory framework for currency, which is different from the regulatory framework for commodities, which is different from the regulatory framework for derivatives. And essentially, cryptocurrency and distributed ledger technology hybridizes all of these technologies to the point where they can all be done by one. Now, with regards to the legal definitions and the regulatory definitions of that, leaves us in a very difficult position, in the sense that we have a hybrid asset, a hybrid thing that can do the function of a commodity, of a derivative, of an equity instrument, of a financial asset. And it's a big challenge for regulators all around the world currently, is how do we regulate these hybrid kind of financial instrument, financial services. And this regulatory thing has posed a lot of questions, and the solutions around the world are quite fascinating and have been quite different from each jurisdiction. In the US, you have a number of different frameworks. Wyoming, weirdly enough, has some of the most open cryptocurrency regulations in the world. But at one point, Bitcoin was illegal to trade for dollars in New York. So you have a huge diversity of different regulations on crypto assets in the US. The UK has some of the best in the world. We have what's called Sandbox Regulations, which basically allows all of these financial companies to experiment with different ways of using this technology. And the experimentation allows them to create different applications and different solutions for the use of this in financial services, but they have to maintain two aspects to an extremely high degree, and that is anti-money laundering, know your customer, and know your customer, sorry. So KYC and AML regs are the only thing that UK distributed ledger financial services companies have to adhere to. And considering we just looked at how traceable currency movements are on the Bitcoin blockchain, it is going to be it's actually quite easy to do. There's a number of UK-based companies that actually trace and track the identity of people and prescribe the identities of the people that transacted on different DLT technologies. So Elliptic is a big one in the UK that basically gives sort of like a risk rating score for Bitcoin that has been received by a private company, and shows them all of the services that Bitcoin had been used in and by what people it was used in as well. Contrast that to, say, cold hard cash, which is the most anonymous form of digital transaction of digital current, not digital, because cold hard cash isn't digital, it's analog, right? In your hand. Contrast that with cold hard cash. There is no way that you'll be able to see every single transaction that cash has been involved in and who it's been involved with, to the point that even cold hard cash has a 1 out of 10 banknotes in circulation today has traces of cocaine on it, right? And that's because it's completely anonymous. And if you are looking for an anonymous medium to transact in, cold hard cash is your best option, and not Bitcoin, contrary to what the media likes to report. China has as well like a quasi ban on Bitcoin, where it kind of looks the other way. The books say you shouldn't do it, but it kind of promotes it in weird ways. So it's really weird. And China's actually building their own state-based distributed ledger currency as we speak, which is called what's it called? A central bank digital currency, a CBDC. The European Parliament has also debated CBDCs, and the Bank of England is looking at making and releasing a CBDC as well. China are pretty much ahead of the pack in this respect. They have been testing it this year and last year, and it is nearly a viable technology to be used across the country. And it's not going to replace their current payment services, but it will work alongside them. But that's an interesting use case. So if you look those up, so we are behind. We are really behind. We are still building one, I think, in the UK and in Europe. But China have one that is currently being road tested by a number of. It's like a closed test with a number of people in China testing that as we speak. Law and databases. We've discussed how blockchains can be used actually for a number of different forms of data, and the applications that you can build on top of those data are limitless, in the same way that we've got limitless number of applications available to us built on the internet. So a lot of these internet-based applications, they run on the most simplest of protocols, because these protocols were written when computational power was very low. So they needed to be very slick and streamlined to be accessed by people with sort of really not powerful computers. To put this into example, like the computer that sent a man to the moon is 1,000 times less computationally powerful than the phone that you hold in your hand. And the phone that you hold in your hand, the computer that sent the man to the moon in the 60s was the size of a small building. So, it was over a number of floors, and you've got 1,000 times more computational power in the palm of your hand, which basically means two things. Number one, it means that the programs that were written 20, 30, 40 years ago, and the protocols that were written 20, 30, 40 years ago are so streamlined that they can easily be broken and compromised by the computational power that we have today. And we need to find other ways of securing this data against the computational power that's existed. And we need to think of new protocols and new rules that can essentially secure this data a lot better. So this is something that is now entering the legal field, also encompassing what I was speaking about with regards to financial jurisdictions, different regulatory frameworks and financial jurisdictions. We need to redefine a lot of these technologies, and we need to redefine a lot of our regulatory frameworks and definitions for things like commodities, assets, derivatives, financial instruments, and so forth, to bring them in line with the current technology that is available. Jurisprudence. So what does this mean? What am I talking about right now? Well, jurisprudence, right? Juris, if we look at the Latin etymology of this word, juris is law, prudentia is wisdom and knowledge. So we can kind of try and envision the types of applications from a legal perspective that this technology will be used for, and the laws and regulations needed to secure those applications and make them viable in our legal landscape. And this extends to a number of different things, like this technology has limitless applications. We're limited by our capacity to imagine them. If we were to tell Ray Tomlinson back in the 70s that today, in 50 years, in 50 years' time, we would be able to stream 4K video wirelessly to a tiny little computer that we were holding in our hands via the internet that he was sending emails on. You know, he would say that we were watching too much Star Trek, and that was pretty outlandish. Even in the 80s and the 90s, if you were to tell people that they would be able to stream wirelessly and have international video calls with people wirelessly from their mobile phones in the palm of their hands, they would have still thought that, you know, you were imagining a crazy application that was, you know, at that time they thought it was impossible, because 4K video wasn't even in existence. Even video that was you know, like 380 by 380, which is the resolution of VHS. Even VHS video calls was a bit of a pipe dream back then. And the idea that you could digitize that was a pipe dream in itself. But now we've got 4K encoding used by YouTube, and all of these technologies have been made available despite them being unimaginable decades ago. So in the same respect, the applications that we could run on Bitcoin and cryptocurrency extends to a number of different use cases, from public law to giving everybody sort of their own digital public and private keys for their digital data that allows them to control who has access to what data, and whoever does access that data will be able to pay them publicly for how that data has been accessed, to smart contracts, digitizing physical property and keeping medical records, financial records, and property records more secure, which allows us to kind of look at intellectual property, succession, and digitizing physical property as well. So, you know, to the point where a number of different use cases become realized, like, for example, you will be able to kind of see who built the medical instruments that are going to be used in your operation, see when they were built, see which machine in the factory built them, and see if there have been any defects in any of the other operations that those components from the same lineage had ever been happened, so you can spot them well before they even come across, and we can create a transparent digital landscape, which gives the user in control, makes the user completely in control of the data. From every like to every email. And is this being trialed in any country as we speak? Yes, it actually is. So a global leader currently in this space is, believe it or not, Estonia. Estonia actually run a number of government services on a blockchain, and they interact with a number of different digital databases. So the medical database can be accessed by law enforcement, which means that once they charge or arrest someone or detain someone, they have access to their medical records pretty instantly, so they'll know any requirements that they may or may not have. Their property registry as well, their business registry. You can register a company in Estonia in, like, you know, as quick as you can in the UK, but it's even more secure in a lot of respects, and it's more connected with other databases. Whereas, you know, in the UK, we have still got very much what's called data silos. Each governmental organization has a database that's siloed off from all of the other government organizations, in the sense that, like, the NHS database is siloed off from the court database, and the courts will have to issue like a freedom, an access request, and that can take weeks, and it might be lost, or it might be compromised or deleted, and whatnot. Whereas in Estonia, it's all pretty much instantly available. As long as you've got the correct private key to access certain data, you can access it, which basically has made, if you read the graph, apparently, and it's all only, it's not everything that has been added. There are still data silos, governmental data silos in Estonia that are still being used in a data silo, but they are looking to bring them into this ecosystem very soon. But officials have already reported that what they currently have in place has saved over 1,400 years of equivalent working time per year. Because if you think about it, the amount of time it takes for an information request to get access of information from a government silo can take 3 months for every request. So if you boil that 3 months down to 2 minutes for every single request, you can find that Estonia saves 1,400 years of working and waiting time per year, right? On all of its sort of administration and administrative resources, which is a huge sort of, imagine what you can do with 1,400 years of extra time on your hands, right? You could do lots of different things, and that's exactly what's been happening in Estonia. Estonia became the first European country to have self-driving shuttle bus services that are now a part of daily life on the streets of Tallinn, the capital of Estonia. But essentially, what this also creates is a ledger and a record of non-fungible digital events. And we are familiar now with NFTs. We've seen NFTs in the news a lot recently, with the idea that artists are selling their non-fungible digital talents or tokens on the internet via NFTs. And what is a non-fungible? What does non-fungible mean, right? Non-fungible means something that isn't isn't exchangeable for something that is the same of it. Whereas currency is completely fungible, right? I can exchange my pounds for pretty much anything. I can buy anything with my pounds. Same with Bitcoin. I can buy almost anything with my Bitcoin on a number of exchanges and so forth. Whereas the non-fungible tokens or non-fungible digital assets are things like pieces of art which can be bought or sold, but aren't really fungible for another piece of art that is the same, or a bit of digital music, which is going to be its own piece of digital music, and it will be stored as its own separate identity, and it will have its own sort of serial number, we should call it, like if you want to think of it in terms of serial numbers, and it's non-fungible, right? It will just be that digital piece of music with that serial number. Like, I can't use that as a currency. And in essence, with DLT and blockchains, you have non-fungible digital events. You have a digital record of non-fungible events. Like every time a person in Tallinn gets on one of these self-driving shuttle buses and they use their government-issued digital identity card, there is a record of that transaction taking place, and it's non-fungible. And this can have huge implications for data science and jurisprudence as well. Like, in this example specifically, if there is an accident and the people on the bus are all hurt, whose fault is it? Is it the fault of the autonomous bus, or is it the fault of a driver in another car? Will this lead to more strict liability offences, where as long as they can show indefinitely that your identity was was in use, you are strictly liable. And will these things have legal identities as well? Will this self-driving shuttle bus have its own legal identity in the same way that companies have their own legal identity? Because again, this shuttle bus, it's got its own digital wallet. It's taking money. It's in the future they could even drive themselves to get recharged and pay the recharging site to charge them up, which kind of gives it its own persona, its own legal persona. And these are a bunch of jurisprudence challenges that are going to be solved, that will need to be solved by lawyers in the near future. But essentially, I hope I've given you a lot of food for thought. I hope I've given you a good sort of helicopter view understanding of what distributed ledger technology is and why it is groundbreaking and going to change the world as we know it in the coming decades, in a similar vein to how the internet changed the world as we know it over the last 5 decades. Anyways, thank you very much. I've been Raphael Shalaby. I hope you've enjoyed the talk. If you've got any questions, feel free to email me, and I will be happy to take them and respond to you in the near future. Thank you again, and I hope you enjoyed this recording.